United States. Securities and Exchange Commission. Washington, District of Columbia, 20549. Form 8K. Current report. Pursuant to Section 13 or 15d of the Securities Exchange Act of 1934. Date of report. Date of earliest event reported, July 21, 2020. Exact name of registrant is specified in its charter. The Coca-Cola Company. State or other jurisdiction of incorporation. Delaware. Commission file number 001-02217. IRS employer identification number 58062845. Address of principal executive offices. 1 Coca-Cola Plaza, Atlanta, Georgia. Zip code 30313. Registrant's telephone number, including area code 404-676-2121. Securities registered pursuant to Section 12B of the Act. Title of each class. Trading symbols. Name of each exchange on which registered. Common stock, 25 cents par value. KO New York Stock Exchange, 0.000% notes due 2021. KO21B. Floating rate notes due 2021. KO21C. 1.125% notes due 2022. KO22. 0.125% notes due 2022. KO22B. 0.75% notes due 2023. KO23B. 0.500% notes due 2024. KO24. 1.875% notes due 2026. KO26. 0.750% notes due 2026. KO26C. 1.125% notes due 2027. KO27. 1.250% notes due 2031. KO31. 1.625% notes due 2035. KO35. 1.100% notes due 2036. KO36. Item 2.02. Results of operations and financial condition. Attached as Exhibit 99.1 is a copy of a press release of the Coca-Cola Company, dated July 21, 2020, reporting the Coca-Cola Company's financial results for the second quarter and year-to-date 2020. The information in this Item 2.02, including the Exhibit 99.1 attached hereto, shall not be deemed, filed, for purposes of Section 18 of the Securities Exchange Act of 1934, as amended, nor shall it be deemed incorporated by reference in any filing under the Securities Act of 1933, as amended, except as shall be expressly set forth by specific reference in such filing. Item 9.01d. Financial statements and exhibits. Exhibit index. Exhibit number. Description. Exhibit 99.1. Press release of the Coca-Cola Company, dated July 21, 2020, reporting the Coca-Cola Company's financial results for the second quarter and year-to-date 2020. Exhibit 104. Cover page interactive data file. The cover page XBRL tags are embedded within the iXBRL document. Signatures. Pursuant to the requirements of the Securities Exchange Act of 1934, the registrant has duly caused this report to be signed on its behalf by the undersigned, thereunto duly authorized. The Coca-Cola Company. Registrant. Date, July 21, 2020. By, Mark Randazza. Mark Randazza, Vice President, Assistant Controller and Chief Accounting Officer. Coca-Cola reports second quarter 2020 results. Provides update on strategic actions in rapidly evolving business climate. Global unit case volume declined 16%. Net revenues declined 28%. Organic revenues non-GAAP declined 26%. Operating income declined 34%. Comparable currency. Neutral operating income non-GAAP declined 25%. Operating margin was 27.7% versus 29.9% in the prior year. Comparable operating margin non-GAAP was 30.0% versus 30.3% in the prior year. EPS declined 32% to 41 cents. Comparable EPS non-GAAP declined 33% to 42 cents. Atlanta, July 21, 2020. The Coca-Cola Company today reported second quarter 2020 results and provided an update on strategic actions that are positioning the system to emerge stronger from the ongoing coronavirus pandemic. The Coca-Cola system remained agile in the second quarter, with a focus on maintaining a safe environment for employees while also providing necessary products and services to consumers, customers, and communities during this unprecedented time. I'm proud of the people of the Coca-Cola system as we continue to adjust and accelerate our strategies in this fast-changing landscape, said James Quincy, Chairman and CEO of the Coca-Cola Company. We believe the second quarter will prove to be the most challenging of the year. However, we still have work to do as we drive our pursuit of beverages for life and meet evolving consumer needs. Highlights: quarterly performance. Revenues: net revenues declined 28% to $7.2 billion. Organic revenues non-GAAP declined 26%. Revenue performance included a 22% decline in concentrate sales and a 4% decline in price mix. The revenue declines were primarily driven by pressure in away-from-home channels, which represent approximately half of the company's revenues. Operating margin, which included items impacting comparability, was 27.7% versus 29.9% in the prior year, while comparable operating margin non-GAAP was 30.0% versus 30.3% in the prior year. Operating margin contraction was primarily driven by top-line pressure and currency headwinds, partially offset by effective cost management. Earnings per share, EPS, declined 32% to 41 cents, and comparable EPS non-GAAP declined 33% to 42 cents. Market share. The company lost value share in total non-alcoholic ready-to-drink (NARTD) beverages as an underlying share gain was more than offset by negative channel mix due to pressure in away-from-home channels, where the company has a strong share position. Cash flow. Year-to-date cash from operations was $2.8 billion, down 38%. Free cash flow non-GAAP was $2.3 billion, down 40%. Business environment and strategic actions update. Since the company's last earnings update in April, global unit case volume trends have improved sequentially, from a decline of approximately 25% in April to a decline of approximately 10% in June. Unit case volume for July month to date was down mid-single digits globally. Performance has been driven by improving trends in away-from-home channels, along with sustained, elevated sales in at-home channels. The improvement in away-from-home trends during the quarter closely correlated with the easing of lockdowns, and the company expects this correlation to continue in the second half of 2020. While the company believes the second quarter will be the most severely impacted quarter of the year, given the ongoing uncertainty surrounding the coronavirus pandemic and levels of lockdown, the ultimate impact on full-year 2020 results is unknown. The company's balance sheet remains strong, and the company is confident in its liquidity position as it continues to navigate through the crisis. Despite the high degree of uncertainty, the company is committed to emerging stronger by gaining share in consumers, maintaining strong system economics, strengthening its reputation with stakeholders, and positioning the organization to win in the new reality. The company is accelerating its strategy to accomplish these goals. This includes focusing investments against a defined growth portfolio by prioritizing brands best positioned for consumer reach and share advantage. The company will also streamline the innovation pipeline against initiatives that are scalable regionally or globally, as well as maintain a disciplined approach to local experimentation in order to further strengthen the company's leader, challenger, and explorer framework. The portfolio will be supported by a refreshed marketing approach, with a step change in marketing investment effectiveness and efficiency. The company will also lead the Coca-Cola system in driving system-wide efficiencies to support these investments, and will invest in new capabilities to capitalize on emerging, lasting shifts in consumer behaviors. Company updates. Refresh the world, make a difference. In the midst of unprecedented challenges, the company remains grounded in its purpose. For example, the Coca-Cola Foundation has partnered with the world's largest humanitarian network, the International Red Cross and Red Crescent Movement, to help provide hospitals with critical medical equipment and supplies, to support community relief programs, and to fund public coronavirus education and awareness campaigns. The partnership has supported programs in more than 60 countries, reaching an estimated 7.5 million people impacted by the pandemic. Driving relevance with loved brands. In the first original ad during the pandemic for brand Coca-Cola, the company celebrates the rediscovered joy in sharing a meal with loved ones. The Great Meal features 13 real households in 8 countries preparing and sharing home-cooked meals over an ice-cold Coca-Cola, bringing to life the comfort and authenticity of the brand's connection to food. The Great Meal kicks off a global campaign for brand Coca-Cola, Together Tastes Better, which is rolling out this month. This modular, digital-first campaign was created for Coca-Cola teams around the world to tailor and localize for their markets and platforms. Together Tastes Better is the latest example of how the company is leveraging marketing investments for the highest impact and largest reach. Innovating quickly to address consumer needs, the company recently announced plans to roll out a new pouring option to meet consumer needs with its latest Coca-Cola Freestyle technology innovation: contactless, mobile pouring using a smartphone. As the coronavirus pandemic continues to reshape consumer behaviors, the contactless Coca-Cola Freestyle solution allows consumers to choose and pour drinks in just a few seconds, without creating an account or downloading an app. The mobile experience is rolling out to Coca-Cola Freestyle dispensers across the United States by the end of the year. Addressing social justice concerns, the company is taking a multifaceted approach to social justice, focusing on listening, leading, investing and advocating. This includes meeting with stakeholders, employees and other business leaders. The company has paused social media activity for July to review policies, including its own, and to hold partners to a higher level of accountability and transparency. The company has committed to spend an incremental $500 million with Black-owned suppliers over the next 5 years in the United States. In support of social justice, the Coca-Cola Foundation has contributed $4 million to several initiatives and, to date, the company has contributed an additional $1.3 million through brands Coca-Cola and Sprite. Operating review. 3 months ended June 26, 2020. Revenues and volume. Operating income and EPS. Note: certain rows may not add due to rounding. 1. For bottling investments, this represents the % change in net revenues attributable to the increase-decrease in unit case volume computed based on total sales rather than average daily sales in each of the corresponding periods after considering the impact of structural changes. 2. Organic revenues, comparable currency-neutral operating income and comparable currency-neutral EPS are non-GAAP financial measures. Refer to the reconciliation of GAAP and non-GAAP financial measures section 3. Due to the combination of multiple business models in the Global Ventures segment, the composition of concentrate sales and price mix may fluctuate materially on a periodic basis. Therefore, the company places greater focus on revenue growth as the best indicator of underlying performance of the segment. 4. Reported operating loss for Global Ventures for the 3 months ended June 26, 2020 was $102 million. Reported operating income for Global Ventures for the 3 months ended June 28, 2019 was $73 million. Therefore, the % change is not meaningful. In addition to the data in the preceding tables, second quarter operating results included the following. Consolidated. Price mix declined 4% for the quarter, driven by negative channel and package mix due to the impact of the coronavirus. Price mix was also impacted by negative segment mix from Global Ventures and bottling investments. Concentrate sales were 6 points behind unit case volume due to cycling the timing of shipments from the prior year along with rationalization of stock levels after safety stock building in the first quarter of the year. Year-to-date concentrate sales were 3 points behind unit case volume, impacted by 1 less day and cycling the timing of certain shipments from the prior year related to the Brexit bottler inventory build. Unit case volume declined 16%, as all operating groups experienced coronavirus-related pressure, particularly in away-from-home channels. Category cluster performance was as follows: sparkling soft drinks declined 12%, led by a decline in India, Western Europe and the fountain business in North America due to pressure in away-from-home channels. Trademark Coca-Cola declined 7%. Coca-Cola Zero Sugar declined 4% in the quarter while growing 2% year-to-date. Juice, dairy and plant-based beverages declined 20%, driven by pressure in the Asia-Pacific and Europe, Middle East and Africa operating groups. Water, enhanced water and sports drinks declined 24%, led by Asia-Pacific, primarily due to a decline in lower-margin water brands. Tea and coffee declined 31%, driven by the impact of the temporary closures of nearly all of the Costa retail stores in Western Europe. Operating income declined 34%, which included a headwind from items impacting comparability in addition to currency headwinds. Comparable currency-neutral operating income (non-GAAP) declined 25%, driven by top-line pressure due to the coronavirus pandemic, partially offset by effective cost management across operating groups along with timing of expenses. Europe, Middle East and Africa. Price mix declined 9% for the quarter driven by negative channel and package mix in Europe. Price mix was also impacted by negative geographic mix due to better performance in emerging and developing markets versus developed markets. Concentrate sales ran 9 points behind unit case volume, largely due to cycling the timing of shipments from the prior year along with rationalization of stock levels after safety stock building in the first quarter. Unit case volume declined 17%, primarily related to lockdown restrictions across the majority of markets. Operating income declined 31%, impacted by a 4-point currency headwind. Comparable currency-neutral operating income (non-GAAP) was down 27% driven by top-line pressure due to the coronavirus, partially offset by effective cost management along with timing of expenses. The company lost value share in total NARTD beverages largely driven by negative channel mix due to pressure in away-from-home channels, where the company has a strong share position. Latin America. Price mix grew 5%, led by price realization and package initiatives in Mexico. Concentrate sales trailed unit case volume by 9 points, largely due to cycling the timing of shipments from the prior year along with rationalization of stock levels after safety stock building in the first quarter. Unit case volume declined 9% led by declines in Argentina, Mexico and Brazil primarily due to the impact of the coronavirus. Operating income declined 14%, which included a headwind from items impacting comparability and an 18-point currency headwind. Comparable currency-neutral operating income (non-GAAP) grew 6%, primarily due to effective cost management across all business units along with timing of expenses. The company gained value share in total NARTD beverages, driven by share gains in sparkling soft drinks, the juice, dairy and plant-based beverages category cluster in addition to the water, enhanced water and sports drinks category cluster. North America. Price mix was even for the quarter as solid growth in the juice and dairy finished goods businesses was entirely offset by pressure in the fountain business and away-from-home channels. Unit case volume declined 16%, largely driven by pressure in the fountain business and away-from-home channels. The decline was partially offset by solid growth in Farlife and Simply. Operating income declined 31%, which included a headwind from items impacting comparability. Comparable currency-neutral operating income (non-GAAP) declined 21% driven by top-line pressure due to the coronavirus. The company lost value share in total NARTD beverages due to coronavirus-related lockdown restrictions in away-from-home channels, where the company has a strong share position. Asia Pacific. Price mix declined 1% due to negative channel mix in key markets, partially offset by positive geographic mix. Concentrate sales ran 3 points behind unit case volume, largely due to rationalization of stock levels after safety stock building in the first quarter. Unit case volume declined 18%, primarily due to strict lockdowns in India to help prevent the spread of the coronavirus. The unit case volume decline was partially offset by positive performance in China. Operating income declined 11%, impacted by a 2-point currency headwind. Comparable currency-neutral operating income (non-GAAP) declined 9%, driven by top-line pressure due to the coronavirus across most markets, partially offset by effective cost management. The company gained value share in total NARTD beverages, driven by a solid share gain in sparkling soft drinks. Global Ventures. Net revenues declined 53%, impacted by a 2-point currency headwind. Organic revenues non-GAAP declined 52%. The revenue declines were primarily driven by the impact of the temporary closures of nearly all of the Costa retail stores in Western Europe. The operating loss was primarily driven by the impact of the temporary closures of nearly all of the Costa retail stores in Western Europe. Bottling investments. Price mix grew 3% for the quarter due to trade promotion optimization in most markets as well as positive geographic mix. Unit case volume declined 36% driven by India and South Africa due to the impact of the coronavirus. Operating income declined 89%, which included a headwind from items impacting comparability and a 21-point currency tailwind. Comparable currency-neutral operating income non-GAAP declined 98%, driven by top-line pressure in India and South Africa due to the coronavirus. Operating review. 6 months ended June 26, 2020. Revenues and volume. Operating income and EPS. Note, certain rows may not add due to rounding. 1. For bottling investments, this represents the percent change in net revenues attributable to the increase-decrease in unit case volume computed based on total sales rather than average daily sales in each of the corresponding periods after considering the impact of structural changes. 2. Organic revenues, comparable currency-neutral operating income and comparable currency-neutral EPS are non-GAAP financial measures. Refer to the reconciliation of GAAP and non-GAAP financial measures section 3. Due to the combination of multiple business models in the Global Ventures segment, the composition of concentrate sales and price mix may fluctuate materially on a periodic basis. Therefore, the company places greater focus on revenue growth as the best indicator of underlying performance of the segment. 4. Reported operating loss for Global Ventures for the 6 months ended June 26, 2020 was $83 million. Reported operating income for Global Ventures for the 6 months ended June 28, 2019 was $139 million. Therefore, the percent change is not meaningful. Outlook. Full year 2020 considerations. As the coronavirus pandemic continues to evolve, there is uncertainty around its ultimate impact. Therefore, the company's full-year financial and operating results cannot be reasonably estimated at this time. For comparable net revenues non-GAAP, the company expects a 3% to 4% currency headwind based on the current rates and including the impact of hedged positions. For comparable operating income non-GAAP, the company expects a high single-digit currency headwind based on the current rates and including the impact of hedged positions. The company's underlying effective tax rate non-GAAP is estimated to be 19.5%. Third quarter 2020 considerations. Comparable net revenues non-GAAP are expected to include a 3% to 4% currency headwind based on the current rates and including the impact of hedged positions. Comparable operating income non-GAAP is expected to include a 7% to 8% currency headwind based on the current rates and including the impact of hedged positions. Notes. All references to growth rate percentages and share compare the results of the period to those of the prior year comparable period. All references to volume and volume percentage changes indicate unit case volume, unless otherwise noted. All volume percentage changes are computed based on average daily sales, unless otherwise noted. Unit case means a unit of measurement equal to 192 U.S. fluid ounces of finished beverage, 24 8-ounce servings, with the exception of unit case equivalents for Costa non-ready-to-drink beverage products which are primarily measured in number of transactions. Unit case volume means the number of unit cases or unit case equivalents of company beverages directly or indirectly sold by the company and its bottling partners to customers or consumers. Concentrate sales represents the amount of concentrates, syrups, beverage bases, source waters and powders, minerals, in all instances expressed in equivalent unit cases, sold by, or used in finished beverages sold by, the company to its bottling partners or other customers. For Costa non-ready-to-drink beverage products, concentrate sales represents the amount of coffee beans and finished beverages, in all instances expressed in equivalent unit cases, sold by the company to customers or consumers. In the reconciliation of reported net revenues, concentrate sales represents the percent change in net revenues attributable to the increase-decrease in concentrate sales volume for the geographic operating segments and the Global Ventures operating segment after considering the impact of structural changes. For the Bottling Investments operating segment, this represents the percent change in net revenues attributable to the increase-decrease in unit case volume computed based on total sales rather than average daily sales in each of the corresponding periods after considering the impact of structural changes. The Bottling Investments operating segment reflects unit case volume growth for consolidated bottlers only. Price mix represents the change in net operating revenues caused by factors such as price changes, the mix of products and packages sold, and the mix of channels and geographic territories where the sales occurred. First quarter 2020 financial results were impacted by one less day as compared to the same period in 2019, and fourth quarter 2020 financial results will be impacted by 2 additional days as compared to the same period in 2019. Unit case volume results for the quarters are not impacted by the variances in days due to the average daily sales computation referenced above. Conference call. The company is hosting a conference call with investors and analysts to discuss second quarter 2020 operating results today, July 21, 2020, at 8:30 a.m. Eastern Time. The company invites participants to listen to a live webcast of the conference call on the company's website, http://www.coca-colacompany.com, in the Investors section. An audio replay in downloadable digital format and a transcript of the call will be available on the website within 24 hours following the call. Further, the Investors section of the website includes certain supplemental information and a reconciliation of non-GAAP financial measures to the company's results as reported under GAAP, which may be used during the call when discussing financial results. Contacts: investors and analysts, Tim Leverage, Co-Investor Relations at Coca-Cola.com Media, Scott Leith, Slaith at Coca-Cola.com. The Coca-Cola Company and subsidiaries. Condensed consolidated statements of income. Unaudited. In millions except per share data. 3 months ended, June 26, 2020. Net operating revenues. $7,150. Cost of goods sold. $3,013. Gross profit. $4,137. Selling, general and administrative expenses. $1,983. Other operating charges. $173. Operating income. $1,981. Interest income. $100. Interest expense. $274. Equity income loss net. $176. Other income loss net. $214. Income before income taxes. $2,197. Income taxes. $438. Consolidated net income. $1,759. Less. Net income loss attributable to non-controlling interests. $20. Net income attributable to shareowners of the Coca-Cola Company. $1,779. Basic net income per share. 41 cents. Diluted net income per share. 41 cents. Average shares outstanding. 4,295. Effect of dilutive securities. 21. Average shares outstanding assuming dilution. 4,316. Note: certain growth rates may not recalculate using the rounded dollar amounts provided. 1. Calculated based on net income attributable to shareowners of the Coca-Cola Company. The Coca-Cola Company and subsidiaries. Condensed consolidated statements of income. Unaudited. In millions except per share data. 6 months ended, June 26, 2020. Net operating revenues. $15,751. Cost of goods sold. $6,384. Gross profit, $9,367. Selling, general and administrative expenses, $4,631. Other operating charges, $375. Operating income, $4,361. Interest income, $212. Interest expense, $467. Equity income loss net, $343. Other income loss net, $758. Income before income taxes, $5,207. Income taxes, $653. Consolidated net income, $4,554. Less, net income loss attributable to non-controlling interests. Net income attributable to shareowners of the Coca-Cola Company, $4,554. Basic net income per share, $1.06. Diluted net income per share, $1.05. Average shares outstanding, 4,292. Effective dilutive securities, 29. Average shares outstanding assuming dilution, 4,321. Note, certain growth rates may not recalculate using the rounded dollar amounts provided. 1. Calculated based on net income attributable to shareowners of the Coca-Cola Company. The Coca-Cola Company and subsidiaries. Condensed consolidated balance sheets. Unaudited. In millions except par value. June 26, 2020. Assets. Current assets. Cash and cash equivalents, $10,037. Short-term investments, $7,551. Total cash, cash equivalents and short-term investments, $17,588. Marketable securities, $2,228. Trade accounts receivable, less allowances of $549 and $524, respectively. 3,849. Inventories, 3,501. Prepaid expenses and other assets, 2,205. Total current assets, 29,371. Equity method investments, 18,189. Other investments, 746. Other assets, 5,875. Deferred income tax assets, 2,366. Property, plant and equipment, net, 10,695. Trademarks with indefinite lives, 10,172. Bottlers franchise rights with indefinite lives, 103. Goodwill, 16,617. Other intangible assets, 555. Total assets, $94,689. Liabilities and equity. Current liabilities, accounts payable and accrued expenses, $11,668. Loans and notes payable, $9,423. Current maturities of long-term debt, $5,181. Accrued income taxes, $576. Total current liabilities, $26,848. Long-term debt, $37,729. Other liabilities, $8,954. Deferred income tax liabilities, $1,969. The Coca-Cola Company shareowners' equity. Common stock, 25 cents par value. Authorized, 11,200 shares. Issued, 7,040 shares. 1,760. Capital surplus, 17,367. Reinvested earnings, 66,888. Accumulated other comprehensive income loss, 16,460. Treasury stock, at cost, 2,745 and 2,760 shares, respectively. 52,071. Equity attributable to shareowners of the Coca-Cola Company, 17,484. Equity attributable to non-controlling interests, 1,705. Total equity, 19,189. Total liabilities and equity, $94,689. The Coca-Cola Company and subsidiaries. Condensed consolidated statements of cash flows. Unaudited. In millions. 6 months ended June 26, 2020. Operating activities. Consolidated net income, $4,554. Depreciation and amortization, $748. Stock-based compensation expense, $36. Deferred income taxes, $39. Equity income loss, net of dividends, $212. Foreign currency adjustments, $67. Significant gains losses, net, $901. Other operating charges, $341. Other items, $52. Net change in operating assets and liabilities, $1,726. Net cash provided by operating activities, $2,786. Investing activities. Purchases of investments, $8,294. Proceeds from disposals of investments, $2,649. Acquisitions of businesses, equity method investments and non-marketable securities, $984. Proceeds from disposals of businesses, equity method investments and non-marketable securities, 46. Purchases of property, plant and equipment, 536. Proceeds from disposals of property, plant and equipment, 112. Other investing activities, 40. Net cash provided by used in investing activities, 6,967. Financing activities. Issuances of debt, 19,775. Payments of debt, 10,304. Issuances of stock, 444. Purchases of stock for treasury, 93. Dividends, 1,761. Other financing activities, 16. Net cash provided by used in financing activities, 8,045. Effective exchange rate changes on cash, cash equivalents, restricted cash and restricted cash equivalents, 172. Cash, cash equivalents, restricted cash and restricted cash equivalents. Net increase-decrease in cash, cash equivalents, restricted cash and restricted cash equivalents during the period. 3,692. Cash, cash equivalents, restricted cash and restricted cash equivalents at beginning of period. 6,737. Cash, cash equivalents, restricted cash and restricted cash equivalents at end of period. 10,429. Less, restricted cash and restricted cash equivalents at end of period. 392. Cash and cash equivalents at end of period, $10,037. The Coca-Cola Company and subsidiaries. Operating segments and corporate, unaudited, in millions. 3 months ended June 26, 2020. Net operating revenues, consolidated, $7,150. Operating income loss, $1,981. Income loss before income taxes, $2,197. Note, certain growth rates may not recalculate using the rounded dollar amounts provided. 1. During the 3 months ended June 26, 2020, intersegment revenues were $75 million for Europe, Middle East and Africa, $1 million for North America, $115 million for Asia Pacific and $1 million for bottling investments. During the 3 months ended June 28, 2019, intersegment revenues were $126 million for Europe, Middle East and Africa, $4 million for North America, $190 million for Asia Pacific and $2 million for bottling investments. The Coca-Cola Company and subsidiaries. Operating segments and corporate, unaudited, in millions. 6 months ended June 26, 2020. Net operating revenues, consolidated, $15,751. Operating income loss, $4,361. Income loss before income taxes, $5,207. Note, certain growth rates may not recalculate using the rounded dollar amounts provided. 1. During the 6 months ended June 26, 2020, intersegment revenues were $227 million for Europe, Middle East and Africa, $2 million for North America, $254 million for Asia Pacific and $3 million for bottling investments. During the 6 months ended June 28, 2019, intersegment revenues were $264 million for Europe, Middle East and Africa, $6 million for North America, $317 million for Asia Pacific, $2 million for Global Ventures and $4 million for bottling investments. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. The company reports its financial results in accordance with accounting principles generally accepted in the United States (GAAP), or referred to herein as reported. To supplement our consolidated financial statements reported on a GAAP basis, we provide the following non-GAAP financial measures: comparable net revenues, comparable currency-neutral net revenues, organic revenues, comparable operating margin, underlying operating margin, comparable operating income, comparable currency-neutral operating income, comparable EPS, comparable currency-neutral EPS, underlying effective tax rate, and free cash flow, each of which are defined below. Management believes these non-GAAP financial measures provide investors with additional meaningful financial information that should be considered when assessing our underlying business performance and trends. Further, management believes these non-GAAP financial measures also enhance investors' ability to compare period-to-period financial results. Non-GAAP financial measures should be viewed in addition to, and not as an alternative for, the company's reported results prepared in accordance with GAAP. Our non-GAAP financial measures do not represent a comprehensive basis of accounting. Therefore, our non-GAAP financial measures may not be comparable to similarly titled measures reported by other companies. Reconciliations of each of these non-GAAP financial measures to GAAP information are also included below. Management uses these non-GAAP financial measures in making financial, operating, compensation and planning decisions and in evaluating the company's performance. Disclosing these non-GAAP financial measures allows investors and management to view our operating results excluding the impact of items that are not reflective of the underlying operating performance. Definitions. Currency-neutral operating results are determined by dividing or multiplying, as appropriate, our current period actual US dollar operating results by the current period actual exchange rates that include the impact of current period currency hedging activities to derive our current period local currency operating results. We then multiply or divide, as appropriate, the derived current period local currency operating results by the foreign currency exchange rates that also include the impact of the comparable prior period currency hedging activities used to translate the company's financial statements in the comparable prior year period to determine what the current period US dollar operating results would have been if the foreign currency exchange rates had not changed from the comparable prior year period. Structural changes generally refer to acquisitions and divestitures of bottling operations, including the impact of intercompany transactions among our operating segments. In 2019, the company acquired controlling interests in bottling operations in Zambia, Eswatini and Kenya. The impact of these acquisitions has been included as a structural change in our analysis of net operating revenues on a consolidated basis as well as for the Europe, Middle East and Africa and bottling investments operating segments. In 2019, the company refranchised certain of its bottling operations in India. The impact of this refranchising activity has been included as a structural change in our analysis of net operating revenues on a consolidated basis as well as for the Asia Pacific and bottling investments operating segments. Comparable net revenues is a non-GAAP financial measure that excludes or has otherwise been adjusted for items impacting comparability, discussed further below. Comparable currency-neutral net revenues is a non-GAAP financial measure that excludes or has otherwise been adjusted for items impacting comparability, discussed further below, as well as the impact of changes in foreign currency exchange rates. Management believes the comparable net revenues non-GAAP growth measure and the comparable currency-neutral net revenues non-GAAP growth measure provide investors with useful supplemental information to enhance their understanding of the company's revenue performance and trends by improving their ability to compare our period-to-period results. Organic revenues is a non-GAAP financial measure that excludes or has otherwise been adjusted for the impact of acquisitions, divestitures and structural changes, as applicable, and the impact of changes in foreign currency exchange rates. Management believes the organic revenue non-GAAP growth measure provides users with useful supplemental information regarding the company's ongoing revenue performance and trends by presenting revenue growth excluding the impact of foreign exchange as well as the impact of acquisitions, divestitures and structural changes. The adjustments related to acquisitions, divestitures and structural changes for the 3 and 6 months ended June 26, 2020 and June 28, 2019 consisted of the structural changes discussed above. Additionally, in 2020, the company acquired the remaining equity ownership interest in Farlife, LLC, Farlife. The impact on revenues for Farlife products not previously sold by the company has been included in acquisitions and divestitures in our analysis of net operating revenues on a consolidated basis as well as for the North America operating segment. In 2019, the company acquired the remaining equity ownership interest in CHI Limited, CHI. The impact of this acquisition has been included in acquisitions and divestitures in our analysis of net operating revenues on a consolidated basis as well as for the Europe, Middle East and Africa operating segment for the 6 months ended June 26, 2020. Comparable operating income is a non-GAAP financial measure that excludes or has otherwise been adjusted for items impacting comparability discussed further below. Comparable currency-neutral operating income is a non-GAAP financial measure that excludes or has otherwise been adjusted for items impacting comparability, discussed further below, and the impact of changes in foreign currency exchange rates. Comparable operating margin is a non-GAAP financial measure that excludes or has otherwise been adjusted for items impacting comparability, discussed further below. Underlying operating margin is a non-GAAP financial measure that excludes or has otherwise been adjusted for items impacting comparability, discussed further below, the impact of changes in foreign currency exchange rates, and the impact of acquisitions, divestitures and structural changes, as applicable. Management uses these non-GAAP financial measures to evaluate the company's performance and make resource allocation decisions. Further, management believes the comparable operating income non-GAAP growth measure, comparable currency-neutral operating income non-GAAP growth measure, comparable operating margin non-GAAP measure and underlying operating margin non-GAAP measure enhance its ability to communicate the underlying operating results and provide investors with useful supplemental information to enhance their understanding of the company's underlying business performance and trends by improving their ability to compare our period-to-period financial results. Comparable EPS and comparable currency-neutral EPS are non-GAAP financial measures that exclude or have otherwise been adjusted for items impacting comparability discussed further below. Comparable currency-neutral EPS non-GAAP has also been adjusted for the impact of changes in foreign currency exchange rates. Management uses these non-GAAP financial measures to evaluate the company's performance and make resource allocation decisions. Further, management believes the comparable EPS non-GAAP and comparable currency-neutral EPS non-GAAP growth measures enhance its ability to communicate the underlying operating results and provide investors with useful supplemental information to enhance their understanding of the company's underlying business performance and trends by improving their ability to compare our period-to-period financial results. Underlying effective tax rate is a non-GAAP financial measure that represents the estimated annual effective income tax rate on income before income taxes, which excludes or has otherwise been adjusted for items impacting comparability discussed further below. Free cash flow is a non-GAAP financial measure that represents net cash provided by operating activities less purchases of property, plant and equipment. Management uses this non-GAAP financial measure to evaluate the company's performance and make resource allocation decisions. Items impacting comparability. The following information is provided to give qualitative and quantitative information related to items impacting comparability. Items impacting comparability are not defined terms within GAAP. Therefore, our non-GAAP financial information may not be comparable to similarly titled measures reported by other companies. We determine which items to consider as items impacting comparability, based on how management views our business, makes financial, operating, compensation and planning decisions, and evaluates the company's ongoing performance. Items such as charges, gains and accounting changes which are viewed by management as impacting only the current period or the comparable period, but not both, or as pertaining to different and unrelated underlying activities or events across comparable periods, are generally considered items impacting comparability. Items impacting comparability include, but are not limited to, asset impairments, charges related to our productivity and reinvestment initiatives, and transaction gains/losses, in each case when exceeding a US dollar threshold. Also included are our proportionate share of similar items incurred by our equity method investees, timing differences related to our economic non-designated hedging activities, and timing differences related to unrealized mark-to-market adjustments of equity securities and trading debt securities, regardless of size. In addition, we provide the impact that changes in foreign currency exchange rates had on our financial results, currency-neutral operating results, defined above. Asset impairments. During the 3 and 6 months ended June 26, 2020, the company recorded impairment charges of $8 million and $160 million, respectively, related to discontinuing our Odwalla juice business, and recorded an impairment charge of $55 million related to a trademark in North America, which was primarily driven by the impact of the COVID-19 pandemic, revised projections of future operating results and a change in brand focus in the company's portfolio. The company also recorded an other than temporary impairment charge of $38 million related to one of our equity method investees in Latin America. This impairment charge was primarily driven by the impact of the COVID-19 pandemic and management's view of the timing and extent of recovery. The company also recorded a charge of $13 million for the impairment of goodwill in our bottling operations in the Middle East, which was primarily driven by a recent change in sugar tax laws, and recorded impairment charges totaling $10 million related to several trademarks in Latin America, which were primarily driven by the impact of the COVID-19 pandemic and management's view of the timing and extent of recovery. During the 6 months ended June 26, 2020, the company recorded an impairment charge of $26 million associated with an investment in an equity security without a readily determinable fair value, which was primarily driven by revised projections of future operating results. During the 3 and 6 months ended June 28, 2019, the company recorded an other than temporary impairment charge of $49 million related to one of our equity method investees in Latin America. During the 6 months ended June 28, 2019, the company recorded an other than temporary impairment charge of $286 million related to Coca-Cola Bottlers Japan Holdings Inc. CCBJHI, an equity method investee. Based on the length of time and the extent to which the market value of our investment in CCBJHI was less than our carrying value and the financial condition and near-term prospects of the issuer, management determined that the decline in fair value was other than temporary in nature. During the 6 months ended June 28, 2019, the company also recorded an other than temporary impairment charge of $57 million related to one of our equity method investees in North America. This impairment charge was primarily driven by revised projections of future operating results. Productivity and reinvestment. During the 3 and 6 months ended June 26, 2020, the company recorded charges of $22 million and $61 million, respectively. During the 3 and 6 months ended June 28, 2019, the company recorded charges of $55 million and $123 million, respectively. These charges were related to our productivity and reinvestment initiatives. The costs incurred in 2019 were related to initiatives focused on 4 key areas: restructuring the company's global supply chain, implementing zero-based work, and evolution of zero-based budget principles across the organization, streamlining and simplifying the company's operating model, and further driving increased discipline and efficiency in direct marketing investments. Under this operating model, our business units will be supported by an expanded enabling services organization and a corporate center focused on a few strategic initiatives, policy and governance. The expanded enabling services organization will focus on both simplifying and standardizing key transactional processes and providing support to business units through global centers of excellence. The savings realized from the program will enable the company to fund marketing initiatives and innovation required to deliver sustainable net revenue growth. The savings will also support margin expansion and increased returns on invested capital over time. The costs incurred in 2020 were primarily related to certain remaining initiatives designed to further simplify and standardize our enabling services organization. Equity investees. During the 3 and 6 months ended June 26, 2020, the company recorded net charges of $63 million and $101 million, respectively. During the 3 and 6 months ended June 28, 2019, the company recorded net charges of $26 million and $68 million, respectively. These amounts represent the company's proportionate share of significant operating and non-operating items recorded by certain of our equity method investees. Transaction gains, losses. During the 3 and 6 months ended June 26, 2020, the company recorded charges of $18 million and $29 million, respectively, related to the remeasurement of our contingent consideration liability to fair value in conjunction with the Farlife acquisition. The company also recognized a $2 million gain related to the 2017 refranchising of our China bottling operations, resulting from post-closing adjustments as contemplated by the related agreements. During the 6 months ended June 26, 2020, the company recognized a gain of $902 million in conjunction with our acquisition of the remaining equity ownership interest in Farlife, which resulted from the remeasurement of our previously held equity interest in Farlife to fair value. The company also recognized a gain of $23 million related to the sale of a portion of our ownership interest in certain unconsolidated bottling operations. During the 3 and 6 months ended June 28, 2019, the company recorded an adjustment to reduce the carrying amount of Coca-Cola Beverages Africa Proprietary Limited's, CCBA, fixed assets and definite-lived intangible assets by $160 million as a result of the company's change in plans for CCBA, as it now intends to maintain its controlling stake in CCBA for the foreseeable future. During the 3 and 6 months ended June 28, 2019, the company recorded charges of $29 million and $40 million, respectively, primarily related to costs incurred to refranchise certain of our North America bottling operations. These costs include, among other items, internal and external costs for individuals directly working on the refranchising efforts, severance, special termination benefits, and costs associated with the implementation of information technology systems to facilitate consistent data standards and availability throughout our bottling systems. During the 6 months ended June 28, 2019, the company recorded a charge of $4 million, primarily related to payments made to certain of our unconsolidated bottling partners in North America in order to convert their bottling agreements to a comprehensive beverage agreement with additional requirements. The company also recorded a net charge of $4 million related to the refranchising of certain bottling territories in North America, primarily resulting from post-closing adjustments as contemplated by the related agreements. During the 3 and 6 months ended June 28, 2019, the company also recorded charges of $8 million for non-capitalizable transaction costs associated with pending and closed transactions. During the 6 months ended June 28, 2019, the company recognized a loss of $121 million in conjunction with our acquisition of the remaining equity ownership interest in Kai, which included the remeasurement of our previously held equity interest in Kai to fair value and the reversal of the related cumulative translation adjustments. The company also incurred transaction costs of $46 million associated with the purchase of Costa Limited and recorded a gain of $39 million related to the sale of a portion of our equity ownership interest in Embotelladora Andina S.A. CCBA unrecognized depreciation and amortization. While the company had discussions about a sale of a controlling interest in CCBA with a number of potential partners throughout the period that CCBA was held for sale, during the second quarter of 2019 the company updated its plans for CCBA and now intends to maintain a controlling interest in CCBA for the foreseeable future. As a result, CCBA no longer qualified as held for sale. The amounts in this line item represent the depreciation and amortization that the company would have recorded had CCBA not been classified as held for sale. Other items. Economic non-designated hedges. The company uses derivatives as economic hedges primarily to mitigate the foreign exchange risk for certain currencies and the price risk associated with the purchase of materials used in the manufacturing process as well as the purchase of vehicle fuel. Although these derivatives were not designated and/or did not qualify for hedge accounting, they are effective economic hedges. The changes in fair values of these economic hedges are immediately recognized into earnings. The company excludes the net impact of mark-to-market adjustments for outstanding hedges and realized gains/losses for settled hedges from our non-GAAP financial information until the period in which the underlying exposure being hedged impacts our condensed consolidated statement of income. Management believes this adjustment provides meaningful information related to the impact of our economic hedging activities. During the 3 and 6 months ended June 26, 2020, the net impact of the company's adjustment related to our economic hedging activities resulted in a decrease of $19 million and an increase of $32 million, respectively, to our non-GAAP income before income taxes. During the 3 and 6 months ended June 28, 2019, the net impact of the company's adjustment related to our economic hedging activities resulted in an increase of $9 million and a decrease of $10 million, respectively, to our non-GAAP income before income taxes. Unrealized gains and losses on equity and trading debt securities. The company excludes the net impact of unrealized gains and losses resulting from mark-to-market adjustments on our equity and trading debt securities from our non-GAAP financial information until the period in which the underlying securities are sold and the associated gains or losses are realized. Management believes this adjustment provides meaningful information related to the impact of our investments in equity and trading debt securities. During the 3 and 6 months ended June 26, 2020, the net impact of the company's adjustment related to unrealized gains and losses on our equity and trading debt securities resulted in a decrease of $253 million and an increase of $118 million, respectively, to our non-GAAP income before income taxes. During the 3 and 6 months ended June 28, 2019, the net impact of the company's adjustment related to unrealized gains and losses on our equity and trading debt securities resulted in an increase of $23 million and a decrease of $138 million, respectively, to our non-GAAP income before income taxes. Other. During the 3 and 6 months ended June 26, 2020, the company recorded charges of $44 million related to restructuring our water manufacturing operations in the United States and charges of $39 million related to discontinuing our Odwalla juice business. During the 6 months ended June 28, 2019, the company recorded a charge of $2 million related to tax litigation expense. Certain tax matters. During the 3 and 6 months ended June 26, 2020, the company recorded $1 million and $57 million, respectively, of excess tax benefits associated with the company's stock-based compensation arrangements. During the 3 and 6 months ended June 26, 2020, the company also recorded $10 million and $58 million, respectively, of net tax benefits for changes to our uncertain tax positions, including interest and penalties, as well as for agreed-upon tax matters. During the 6 months ended June 26, 2020, the company recorded $38 million of net tax benefits related to changes in tax laws in certain foreign jurisdictions. During the 3 and 6 months ended June 28, 2019, the company recorded $108 million and $135 million, respectively, related to excess tax benefits associated with the company's stock-based compensation arrangements and the reversal of a U.S. state valuation allowance. During the 3 and 6 months ended June 28, 2019, the excess tax benefits were partially offset by net tax charges of $98 million and $103 million, respectively, for changes to our uncertain tax positions, including interest and penalties, as well as for agreed-upon tax matters. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions except per share data. 3 months ended June 26, 2020. Gross margin, 57.9%. Operating margin, 27.7%. Note, certain columns may not add due to rounding. Certain growth rates may not recalculate using the rounded dollar amounts provided. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions except per share data. 3 months ended June 26, 2020. Effective tax rate, 19.9%. Note, certain columns may not add due to rounding. Certain growth rates may not recalculate using the rounded dollar amounts provided. 1. The income tax adjustments are the calculated income tax benefits charges at the applicable tax rate for each of the items impacting comparability with the exception of certain tax matters previously discussed. 2. Represents net income attributable to shareowners of the Coca-Cola Company. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions except per share data. 6 months ended June 26, 2020. Gross margin, 59.5%. Operating margin, 27.7%. Note, certain columns may not add due to rounding. Certain growth rates may not recalculate using the rounded dollar amounts provided. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions except per share data. 6 months ended June 26, 2020. Effective tax rate, 12.5%. Note, certain columns may not add due to rounding. Certain growth rates may not recalculate using the rounded dollar amounts provided. 1. The income tax adjustments are the calculated income tax benefits charges at the applicable tax rate for each of the items impacting comparability with the exception of certain tax matters previously discussed. 2. Represents net income attributable to shareowners of the Coca-Cola Company. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. Diluted net income per share. 3 months ended June 26, 2020. Percent change, reported GAAP. 32% currency impact. 6% change, currency neutral, non-GAAP. 26% impact of items impacting comparability, non-GAAP. 1% change, comparable, non-GAAP. 33% comparable currency impact, non-GAAP. 5% change, comparable currency neutral, non-GAAP. 28. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions. Net operating revenues by operating segment and corporate. 3 months ended June 26, 2020. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions. Net operating revenues by operating segment and corporate. 6 months ended June 26, 2020. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions. Operating income loss by operating segment and corporate. 3 months ended June 26, 2020. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions. Operating income loss by operating segment and corporate. 6 months ended June 26, 2020. The Coca-Cola Company and subsidiaries. Reconciliation of GAAP and non-GAAP financial measures. Unaudited. In millions. Operating margin. 3 months ended June 26, 2020. Reported operating margin GAAP. 27.71%. Free cash flow. 6 months ended June 26, 2020. Net cash provided by operating activities GAAP. $2,786. Note: certain growth rates may not recalculate using the rounded dollar amounts provided. About the Coca-Cola Company. The Coca-Cola Company NYSE, KO, is a total beverage company, offering over 500 brands in more than 200 countries and territories. In addition to the company's Coca-Cola brand, our portfolio includes Aids, Ayataka, Costa, Dasani, Del Valle, Fanta, Georgia, Gold Peak, Honest, Innocent, Minute Maid, Powerade, Simply, Smart Water, Sprite, Vitamin Water and Zico. We're constantly transforming our portfolio, from reducing sugar in our drinks to bringing innovative new products to market. We're also working to reduce our environmental impact by replenishing water and promoting recycling. With our bottling partners, we employ more than 700,000 people, helping bring economic opportunity to local communities worldwide. Learn more at www.coca-colacompany.com and follow us on Twitter, Instagram, Facebook and LinkedIn. Forward-looking statements. This press release may contain statements, estimates or projections that constitute forward-looking statements, as defined under U.S. federal securities laws. Generally, the words believe, expect, intend, estimate, anticipate, project, will, and similar expressions identify forward-looking statements, which generally are not historical in nature. Forward-looking statements are subject to certain risks and uncertainties that could cause the Coca-Cola Company's actual results to differ materially from its historical experience and our present expectations or projections. These risks include, but are not limited to, the negative impacts of the novel coronavirus COVID-19 pandemic on our business, obesity and other health-related concerns, evolving consumer product and shopping preferences, increased competition, water scarcity and poor quality, increased demand for food products and decreased agricultural productivity, product safety and quality concerns, perceived negative health consequences of certain ingredients, such as non-nutritive sweeteners and biotechnology-derived substances, and of other substances present in our beverage products or packaging materials, an inability to be successful in our innovation activities, an inability to protect our information systems against service interruption, misappropriation of data or breaches of security, failure to comply with personal data protection and privacy laws, failure to digitize the Coca-Cola system, changes in the retail landscape or the loss of key retail or food service customers, an inability to expand operations in emerging and developing markets, fluctuations in foreign currency exchange rates, interest rate increases, an inability to maintain good relationships with our bottling partners, a deterioration in our bottling partners' financial condition, increases in income tax rates, changes in income tax laws or unfavorable resolution of tax matters, increased or new indirect taxes in the United States and throughout the world, an inability to successfully manage the possible negative consequences of our productivity initiatives, an inability to attract or retain a highly skilled and diverse workforce, increased cost, disruption of supply or shortage of energy or fuel, increased cost, disruption of supply or shortage of ingredients, other raw materials, packaging materials, aluminum cans and other containers, increasing concerns about the environmental impact of plastic bottles and other plastic packaging materials, changes in laws and regulations relating to beverage containers and packaging, significant additional labeling or warning requirements or limitations on the marketing or sale of our products, unfavorable general economic conditions in the United States, unfavorable economic and political conditions in international markets, litigation or legal proceedings, conducting business in markets with high-risk legal compliance environments, failure by our third-party service providers and business partners to satisfactorily fulfill their commitments and responsibilities, failure to adequately protect, or disputes relating to trademarks, formulae and other intellectual property rights, adverse weather conditions, climate change and legal or regulatory responses thereto, damage to our brand image, corporate reputation and social license to operate from negative publicity, whether or not warranted, concerning product safety or quality, workplace and human rights, obesity or other issues, changes in, or failure to comply with, the laws and regulations applicable to our products or our business operations, changes in accounting standards, and inability to achieve our overall long-term growth objectives, deterioration of global credit market conditions, default by or failure of one or more of our counterparty financial institutions, and inability to renew collective bargaining agreements on satisfactory terms, or we or our bottling partners experience strikes, work stoppages or labor unrest, future impairment charges, multi-employer pension plan withdrawal liabilities in the future, and inability to successfully integrate and manage our company-owned or controlled bottling operations or other acquired businesses or brands, and inability to successfully manage our refranchising activities, failure to realize a significant portion of the anticipated benefits of our strategic relationship with Monster Beverage Corporation, global or regional catastrophic events, and other risks discussed in our filings with the SEC, including our annual report on Form 10-K for the year ended December 31, 2019 and our subsequently filed quarterly report on Form 10-Q, which filings are available from the SEC. You should not place undue reliance on forward-looking statements, which speak only at the date they are made. We undertake no obligation to publicly update or revise any forward-looking statements.